Good morning and welcome to Nedgroup Investments Insights. My name is Robin Johnson and I'm really pleased to have Ian Beattie from NS Partners on the phone with us today to discuss the prospects for GEM, and I think you'll be excited by what he's got to tell us. Ian Beattie is the Co-Chief Investment Officer at NS Partners and Portfolio Manager for the Nedgroup Investments Global Emerging Markets Equity Fund. Good morning, Ian.
Good morning, Rob. Thanks for having me.
Well, thanks for joining us. NS Partners have been managing emerging market portfolios since 1996 or longer, with a phenomenal track record of consistent outperformance. So everybody's really sitting on the edge of their seats waiting to hear what you've got to say. A feature that's quite unique about amongst GEM managers is the application of the top-down view, which is based on the cycle of money supply and how this impacts the flow of assets into different regions. Now, interestingly, I received Michael McKenzie's FT Market Forces email last night, and the first lines in that email were quite interesting, given what Ian's going to present on today. And I'll quote for you: "Selling pressure on the US dollar is gaining momentum, reflecting a broader global rebound in other currencies, commodity prices, and equities beyond Wall Street." And he went on to talk about how that had already started happening to quite an extent in May, and how it's continuing into June. On that note, Ian's going to talk to us today about how they look at a 7-factor checklist and how that's giving them quite exciting and strong messages about the prospects for emerging markets coming into the latter part of the year and maybe 2021. So on that note, Ian, I'm going to hand on to you. Please just let me know when you want me to move slides.
Thanks, Rob. Okay, so I'm going to get straight into it because I know we want to rattle through this in time-wise and then hopefully leave some time for questions that you can send through. At NS Partners, as Rob has said, we've been running money in emerging markets for a very long time, and I've been leading that since the fourth quarter of '98, yes, '98. And one of the things we do for many of our clients are in emerging markets and developed markets. So the decision on whether to be in emerging markets up to their max, or whether they should just be at their long-term structural allocation, or whether they should be at the minimum level, is something that we've always helped them with that decision, and indeed run some products that make that decision for them ourselves. And we've got a very simple model. Well, we call it a checklist because it is that basic, right? But it's worked. It's simple, and it's given us historically very clear signals at peaks and troughs. And when there's not much of a signal, it's very clear that there's not much of a signal. So for all those reasons, its simplicity we very much like, and the thing that we like even more is that it's been very effective. So I'm going to share that with you today because it's been a long time since it's been this extreme a reading. Okay, so if we go on to the first page, please, Bob, we can show you exactly what it is up front, and I explain it all and label each one so that you can see for yourselves in case you've got a different view on any one of these indicators. So if we could go to the checklist, please, Rob, that would be great. So on these 7-factor checklists, I'm not sure if it's showing up on your screens or not. We have real money growth, and one of the conditions for emerging markets to outperform developed markets is that this should generally be higher in the emerging world than in the 7 largest industrialized countries. Now, it's not at the moment, but when we get to this, you'll see they are both off the scale. Excess liquidity in the global economy at the moment is the greatest since the GFC. And in fact, broad money in the G7 economies rose to 13% in April. So when these real money indicators are as strong as they are, I don't think it matters too much. And really, the G7 is growing so fast due to the US, due to the Fed, which is pumping money supply into the system faster than at any time we've seen in peacetime. And we'll show that later on. We've got data going back to 1860, which is the American Civil War, and it's growing faster than any time other than a short period during World War II. So that's a lot of dollars out there. So there's no longer a dollar shortage, but we'll go on to that later on. Valuations. Okay, now I know they've got a bit of a bad reputation, but it's if you're going to start on a bull market or a relative bull market, it's usually important to have good valuation support. And our second indicator is that we want lower valuations in emerging markets versus developed markets. We also would like them, if we're going to get a really big move, low in absolute as well as relative terms. Now, at the moment, we look at these numbers and we say, yes, they are low, both in absolute terms and relative to developed markets. But again, a bit like the caveat in the real money growth, it is really the fact that the US looks very expensive. Most other markets look reasonable value here, I think. But emerging markets look especially cheap. The earnings revision cycle, the earnings revision ratio on the third one there also needs to look better relatively. And although earnings revisions are obviously have been falling quite fast, they are showing some signs of recovery in emerging markets. As you'd expect with China and East Asia ahead of the curve on COVID-19, these are obviously ahead of the curve on earnings as well. And again, the US and the Western markets are further behind. So earnings revisions are definitely looking, I was going to say better, but less bad in emerging markets than developed. On the global industrial cycle, it's very, very important here as well to see this beginning to turn. Now, I leave you to make your own mind up on this one, but I would say that the low is in. We've seen the low. From now on, we're in an upswing. And we can all have a big debate about whether the upswing should be, what sort of shape this is. Our economist, Simon Ward, has a very strong view. It's a V shape, but we'll come on to that later on. But I think it definitely looks like we are now in an upswing. If you stop all economic activity other than the government and a few essential services, when you start to come back on stream, you're going to see a very, very large economic recovery. As one pundit told me last week, it's going to be the fastest economic upturn since Noah's Ark found dry land. The next point in the checklist is global excess money. Emerging markets like money growth to be growing faster than the economy needs. That means there's lots of excess liquidity around. Well, I think this is obviously very, very powerful at the moment. The economy is flat on its back, and even if it does start to recover, the amount of money that's been pumped into the system by the Fed and the Bank of England and other central banks is enormous. And remember, this time there is no austerity to offset it on the other side. I think we can agree that there is no political appetite to claw this money back through taxes or through an austerity program. So we've got fiscal boost and we've got massive liquidity monetary policy boost going on. So in our current assessment, we haven't just said it's improving. We've got record. This is the record level of excess money. Commodity prices, again, slightly more controversial, and it depends whether you include energy in here or not. But I think we're going to say they are bottoming overall. Historically, this has been important for emerging markets. It is obviously now not so important for China and India, as they are commodity importers rather than exporters. But I think the data tells us that emerging markets are still positively correlated with commodities. A bit like airlines. In theory, an airline wants the oil price lower, but actually in reality, the share price is positively correlated over the long term because they're both dependent on economic growth. And then lastly is the US dollar. Now, this is one of the ones that we were waiting. This is the caveat. This is the swing factor as well. This is the US dollar is in many ways a function for all of these other items on our list. So if the US dollar is emerging markets like a weaker US dollar, and that's what's happened over the last couple of weeks. The US dollar has peaked. There was a massive dollar shortage, and the Fed has met that dollar shortage. And that's what we're seeing now. So I'm going to go through each of these now and go through them in a bit more detail. But if you're unsure, you just watch the dollar, because in a way that is the sum total of them. So Rob, if we could move forward now, please. And we're looking at real money growth in our next chart. And I'm not going to say much about this one because I think it's pretty plain to see these numbers are enormous. And of course, there's a slight lag on these, a bit like our slides, and they are surging. The G7 number, which is driven by the US, because the Fed is obviously the largest component, but also it's been the most aggressive, is soaring. These numbers are unprecedented. These are higher than the GFC, and the E7 is catching up. The one emerging market country that is not being so aggressive as they have done previously is China. China's being much more measured. But that's because the Chinese, they've loosened monetary policy, but they can ensure that narrow money does turn into broad money by telling their bankers to lend. And they have done. And so we're seeing the People's Bank of China surveys telling us that the bankers are lending at a higher rate than they did even in 2009. So that money is moving through the system. So the big debate here by people who look at these numbers and who will take a different view to us will say, yes, that's just narrow money. That is not leading through to the real economy. This is just a liquidity game like we had in the GFC. Well, I think there's a number of reasons why this isn't going to happen. It'll be more like prior versions of this and not like post-GFC. I haven't got time to go into it in too much detail, but I think we can shortcut and go, look, we can measure to see whether this is flowing through the economy or not, because we can measure whether it's turning into lending. If this turns into loan growth, then it will go to the economy. If this turns into broad money, then it is moving through the economy, not just sitting in narrow money. And that's what we learned from the GFC. That's what we learned from Japan. When Japan burst its bubble, they had episodes of narrow money growth. They never got broad money growth. They never really got asset growth. They never got loan growth. It didn't stay in the country. It just went overseas. So that's what we're watching. That's what we're waiting for. So if we go to the next one here, we'll go to our valuation checklist. And as you can imagine, when everything's fallen as much as it has, emerging markets are looking cheap. We're using a price to book here, because I don't think anybody knows what earnings are at the moment. And it's a bit more reliable over the long term. Yeah, you can use CAPE and things like that, and they all look very good value. So you can see they've both bounced off their lows already, but emerging markets looking very, very cheap over on that basis. The world index being pulled up by the US market, which has led valuations a lot higher. And yes, I know you can say that world is including the US, which has got all those internet names in, and we should pay a lot more for them, and you can't use book value. But the same applies to Alibaba and Tencent in emerging markets as well. So I'm going to skim through that one because I'm sure everybody listening to this call is very capable of looking at your own valuation charts and your own ones of choice. So we go on to the next one, please, Rob. And we can see here the revisions ratios, just to show you how earnings have been axed. And you can see here that emerging markets, really thanks to China, I think, in particular, and Korea and Taiwan, who have not had such an extreme or long period of time of COVID shutdown, and then their productive capacity has recovered quite quick in China's case, and is really in the rest of East Asia and Northeast Asia. They're more worried about what's happening to the rest of the world than about their own countries. So again, that's a big tick in our checklist. Even though they're in the negative side, they are recovering, and emerging markets is better than developed. So whizzing through again, and we're going to just see what we look like on the global industrial cycle. And we would say, look, we're either at the bottom or near the bottom on the industrial cycle on the next page, on page 5. And you can see here that in G7 and E7, real narrow money together has been a very useful indicator for turning points here. It's harder on picking the absolute level, so this might not be as useful for telling you how big the subsequent recovery will be. There may well be problems, but it's very good for timing. Okay, so this is what I'm focusing on here. I'm not focusing on what it's going to look like in 3 or 4
Apologies, ladies and gentlemen. It appears that we've lost Ian for this moment in time. I'll endeavour to get him back on the phone, so please bear with us. And thank you for everyone who's let me know through the Q&A that the sound is a bit too soft. When he comes back on, I'll mention that to him in the first instance to see if he can talk up a bit for us. So thank you. And for everybody else, if you haven't seen the Q&A option at the bottom of the screen, there's a little 2 speech bubble boxes with a question mark in. If you click on that, it should bring up a Q&A panel on the right hand side, which you should be able to type in a question and submit it through to us. We've already had a few people submitting questions that I will pose to Ian when he comes back on the line. Whilst we wait for Ian, please indulge me, and I'll talk through my outro, if you like, so that we don't waste time later on, so that everybody has more time to the day. We're really pleased with the performance that NS Partners have produced on the fund since they began running in April 29th, 2019. As Ian mentioned, they've been running assets in emerging markets since 1996, and he's been managing the portfolio since 1998. But they assumed control of our fund upon launch last year.
Oh,
and
hi Rob, sorry. Where did I get to?
Hello, Ian. Yeah. Well, thanks very much for coming back. Just would you mind just speaking up a little bit more on the phone, please? We've had a few notices that it's quite soft for the audience. Where you got to was on the industrial cycle, and you were talking about the timing of the industrial cycle rather than the magnitude.
Yeah. So there's a huge amount of money out there. We're very, very sure the timing is going to be very soon. But obviously there are caveats with the virus. But there's a lot of reasons why that should be starting to pull through. Other countries have dealt with it. And if there are recurrences, it's mainly been imported cases. So obviously that's a caveat we've got to bear in mind. But the balance probabilities suggests that this will be getting better. And I'll refer back to my Noah's Ark point. When you've stopped the economy, as it restarts, the growth rate is going to look phenomenal. And with all this liquidity, it's either going into asset prices or it's going into the real economy. There is nowhere else for it to go into, really, in terms of size. The chances are it'll be both. So we've just got to work out what the relationship is between those two. And I'll whiz on, I think. So it's going to be big. It's going to be very rapid. I think it's going to be sooner than people think. So we'll go on to page 6 now, please, Rob. I'll shout a bit louder. So here we've got the G7 and the E7, and this is industrial output and both real and broad. So this debate that will now be raging by people who look at these money indicators will be, okay, there's a lot of cash out there, but it doesn't necessarily go into the real economy. And I understand that because that's what happened really after GFC. And that's what happened in Japan. In fact, it left Japan in many cases because they didn't have a solvent banking system to put that money to work. The banks did not lend. Now, this time the banks are in better shape. Hopefully we'll be on page 6 soon. And they will lend it. But we're seeing indications that definitely initially the banks have lent. Now, you can get some false signals because CFOs will draw down the money even if they don't need it, even if they're not going to spend it. But it is moving through the system. So it isn't just narrow money that is accelerating. We're seeing broad money accelerate to record levels as well. We did not see this in Japan in the 90s. So this is new. Okay, so if you think, yeah, Ian, I can see there's lots of liquidity around, but I don't believe it's going to move through the system, then just watch broad money. Just watch bank loan growth, bank asset growth throughout the world. That's the data you need to watch to decide whether it's just going to sit playing financial asset prices, or whether it's going to move through the economy and start doing other things with the economy and other real assets as well. Okay, so this is the indicator to watch, and we're going to go through and look at a few more of these now. If we can page through, Rob, this is the key one. This is the key one in this debate as to whether you can sit playing bonds, or whether you've got to go and buy something else. So if we can move on to page 7, please. We're just going to go through the rest of the checklist before I do a bit of a wrap. But here we can see the metals index, which we would say is nearer the lows than anything else. But it does seem to have been recovering lately. In fact, I've got pages and pages of reports by analysts telling me why not to believe various recoveries in commodity prices. Just like they make excuses when they fall unexpectedly in the bull market, they're now telling me why I shouldn't believe rises on the way up. And then if we can move rapidly forward as well, Rob. Yeah, so that's the industrial commodities index. So just beginning to bounce from the lows there. We expect that to continue to stabilize with all this money as the economists start to get back. Now, yes, I know a lot of this will be year-on-year impacts, but I think at this stage, that doesn't matter. At these valuations, with all this cash sitting on the sidelines, that doesn't matter. I'm not saying we're going to go into a massive bull market here. I'm just saying it's going to be going higher and will be supportive. And then if we can go forward again onto the dollar. Now, this is a couple of days old, and a couple of days in the US dollar lately has been quite significant. We can go on to the US dollar chart. On page 8. Now, this again is a really good barometer. Now, I would say it's almost moved on the dollar so rapidly lately that we're gonna, it got a bit almost oversold in the last couple of days as it comes off from those highs. But you can see on these longer term dollar charts, that's been a big bull market, and I think we're starting to see the turn. Much depends on what goes on in Europe. The Europeans have some big meetings again on whether they're going for fiscal union effectively, whether there's the one banking sector approach, i.e. whether the richer countries are going to underwrite the poorer ones. So there's backtracking on that. That might hit the euro and therefore give a fillip to the dollar. But otherwise, this all looks like we've reached a turning point for the dollar, quite simply because the Fed has printed more money than everyone else. We had a massive dollar shortage, which is why the dollar spiked in the crisis, as often happens at times of crisis. And we've cycled through this much quicker than normal. Everything about this crisis has happened much quicker than anything has ever happened before, bigger and quicker. And so we had a bigger dollar shortage, we had a bigger crisis. The COVID-19 crisis obviously led to the financial crisis much quicker than we've normally done. And the government response has been much quicker and much larger than we've ever seen before. And so sure enough, the dollar spiked more and faster and is now unwinding more and more quickly than we've seen previously. So on page 8 there, you can see the US dollar effective exchange rate on the left-hand side, big spike, and that's being unwound now. If we updated that chart, that would be lower again. And I can't stress enough, emerging markets, like many periphery assets, like a weaker dollar. They like it both directly in terms of trade, but they also, it gives an indication of the liquidity conditions and the risk appetite as well. So the causality of this, I don't think we've got time to explain now, because I'm not sure anybody really knows, because you get into a virtuous circle here, as one feeds off the other. So it's an input. It's also sort of an outcome of that equation. And you can see the emerging market currency index on the right-hand side, basically the corollary of that. So if we move on and we're going to look at some emerging markets now in detail on page 9, I'm going to try and speed up a little. You can see here real narrow money growth on page 9 in almost all emerging markets at record highs and heading higher. So this is huge, unprecedented actually, and they're all heading higher. So the one that's the most modest, the only central bank really that hasn't thrown the rule book away, is the People's Bank of China. And as I said, that's because I think they have less of a problem compared to the rest of the world, but they also want to keep some in reserve because they're probably a bit more cautious, some policy response, but also they have more confidence that their moral suasion is powerful. They can tell their bankers to lend this money, and they are doing so. So I've joked before that they have a very interesting policy tool called the AK-47, which is a very, very powerful monetary policy tool if you have to get all your bankers to do what you want them to do. That's a policy tool that is not in use at the Bank of England or the Federal Reserve or even the ECB, much as I suspect they would like it. So that's the chart on page 9 that you can see those huge moves there. Again, China now looking less exciting, but more conservative. So if you're a bond investor, I would say China looks better. And many places in the world, actually. And that probably is telling you something about the future direction of the dollar and maybe the renminbi, although the renminbi could get caught up in some trade negotiations in the meantime. But I think that looks a pretty good bet from a fixed income investor's point of view. Find the central bank that hasn't thrown the rule book out and invest in their bonds. Now, on page 10, if we can go through that, you can see, I'm just trying to give an idea here of just how vast, how enormous this policy response has been. This isn't just central banks leaning against the wind, or to use that old phrase, or to, help the liquidity situation in a crisis. This is an unprecedented large response. And remember, I'm not talking about the fiscal response here either. The fiscal response in many countries has also been enormous. And I think we can say that they have crossed the line. They are financing, so on page 10 now, if we can, Rob, they are financing the fiscal deficits in many countries now with central bank. That's something that no developed market, no respectable central bank has done in peacetime before. So the only countries that have done that, are the ones where we know what happens to their currencies. And yet here we have the US leading the way, as though it was one of those very, very low quality emerging markets, frontier markets where they've literally printed money. This is beginning to look like helicopter money and printing money, financing of fiscal deficits. But anyway, enough of the moralizing. So on page 10, you can see here that US broad money is at, it's the highest number on there in peacetime since 1860, since the end of the Civil War, 1865 or something. So the only time it's been higher than this was a couple of brief data points during World War II. That's the light green there, which is broad money, or the broadest money we can get over that time horizon. Remember, this is broad money, not narrow. So this isn't about cash being, sitting on in your current account for a rainy day. This is money that is moving through the system much more than if we were looking at narrow. So you can see there on that time horizon, those people that say that won't feed through into GDP, well, occasionally that does happen, but it is the exception. So you've got to be aware that you are betting against the norm on those if you're thinking that isn't going to work. But even if it doesn't work, that money is going somewhere and it's going into asset prices. So quite happy to sit on that one for a while. I think it's a quite remarkable chart, but we better move on to the next one. And shall I hand over to you, Rob, for it? But before we do, I'm just going to finish with a quick summary before Rob goes on to some fund specifics. So I just want to really emphasize that excess liquidity in the global economy is the greatest since the end of the GFC. In fact, if you look at the G7 alone, it rose to 13% in April, which is the fastest growth of broad money, remember, not narrow, since 1976. Money growth is also picking up very strongly in China, but it is surging in other emerging markets, especially Korea, Russia, and Brazil. Notice those are the more cyclical ones. And we note that there's a double-digit percentage gap now opened up between the amount of global money that has been created and the demand to hold money by households and firms. This is the largest since 2009, but it looks like it's going to be much larger. Now, excess liquidity can flow into the economy, which will boost activity, or asset markets, which will boost share prices. Both are likely. Now, assuming a virus containment, either via a vaccine or effective track and trace and testing programs, or even if this virus starts to reduce in efficacy or in virulency, which is often the case as well as they pass through a community, then we would expect a very, very strong bounce back for the economy in 2021. A strong bounce back would result in money flowing into markets and being directed towards cyclical markets, which is what we're starting to see in the last couple of days. And that dollar will give you a good barometer on that. Now, the big debate is whether it's broad money growth is sustained or whether it's just narrow. We think the central banks have said they will do whatever it takes, so they will keep doing this until it works. Our 7-factor checklist is also suggesting that, as is usually the case, emerging markets are a good place to be when you get this kind of environment. And it has a very good track record. One of the key factors has been the dollar. Now, the US is the one growing money growth faster than anywhere. It is relieving the US dollar shortage that was a crisis point not that long ago, when the COVID crisis was rampant. And it raises the possibility of a decline in the US dollar. And this, as we say, is the icing on the cake for the emerging market asset class. US broad money grew at 25% in early May, which is a post-World War II high. It's the highest peacetime number I think we've ever seen. So we're having to adjust our portfolio for this. We're going to have to start getting more cyclical assets. We're going to have to start getting more Russia, Indonesia, Brazil, Korea, Thailand. We need to get some more exposure to this. And you think what every asset manager's done for the last decade, they've just been in the long duration names. The really, really high quality, really, really, the internet names, those with, where we know the growth is going to be great. Well, growth is going to be a bit more common now. So we're going to see an interesting catch up in some other asset prices. So with that, I'll hand over to Rob.
Thank you very much, Ian. That was extremely comprehensive and interesting, and painting a really positive picture for global economy and equity markets, and most importantly, global emerging markets. We have had quite a number of questions, Ian, but given that we're over time, what I'm going to do is I'm going to rapid fire them at you. So let's try and keep these answers short and see what you can get in maybe a minute on these questions. And I'm going to start with a few that that people have asked about, comments you've made within the presentation. So firstly, have you been using the 7-factor checklist for the entire history of your strategy, or has it evolved over time? Is it something quite new?
No, we've been using it for, I think we're into our 3rd decade of using it.
When you're talking decades,
it'd be more dangerous. Yeah, it would be more dangerous to say we think it won't work this time than it would be to say, oh, I think we'll just carry on using it because it's always worked. I mean, we know why it works. I know what to watch for it to no longer work, and it would be the end of the US dollar reserve currency status, and that isn't going to happen overnight. And if actually that happens, then the checklist would probably be too negative. So that's the only thing I can think of why it wouldn't work anymore. In the current environment, it's perfect for it. It's a very good cyclical indicator.
Okay, thank you. And so a couple of questions that are linked to that then, or your comment just then is, one is, what are the risks to this not flowing through this time, in particular to emerging markets? So how can we be sure this is a positive catalyst for emerging markets? And then on the back of that, why would there be a breakdown in broad and narrow money, and why do you specifically mention those two items as being strong indicators?
Yeah, no, those are very good questions. Those are the key risks, really. So the most important risks are they seem very obvious, but if there weren't any risks at all, obviously markets would be there already, and that is the virus. If the virus gets worse, if the second wave isn't small, if it's even bigger, which of course is possible, but I think unlikely, then that will undermine, and that will keep that you won't see broad money. I suspect if you have that, then everybody will just sit on cash, literally. People will hide it under the mattress. They will find ways of avoiding financial repression from governments, which are after your money now, right? And so there'll be all sorts of weird and wonderful distortions, but it will look a bit more like the post-GFC environment in that case. And we'll be pushing those duration names and all sorts of other wonderful ways of avoiding avoiding the repression from governments instead. But you can measure that, so you just watch that. So basically, the risk on that would be massive deflationary shock, and not enough creative destruction. So not enough companies going bust, so that you don't get the pricing power back. Most of this is really about how far you go, rather than whether you do get the turning point. On narrow versus broad, if you only get narrow money growth, then we're all sitting on the cash and we're not getting brave enough to do anything with it, as individuals, as consumers, as savers, as corporate CFOs and corporate boards. So, and a lot of that is to do with pricing power. I think pricing power is going to come back. Now, when we've had a supply shock and a demand shock, and the governments are now paying people in many countries to do nothing, and we've got money growth everywhere, then the risk of this popping up somewhere seems bigger to me. There seems to be a bigger risk of the money causing little pop-ups in inflation. I'm not talking about, I don't know, CPI inflation going particularly high, although maybe in a couple of years it probably will be. But I think there'll be little pockets of suddenly the pricing power is not the same as it was last year. Suddenly that supplier now has pricing power, or that customer does, and it was the other way around before. So the rules about who's been winning and losing could change, and that's why you get the rotation within markets, and that's why emerging markets who've been the wrong end of pricing power. I mean, Apple's had it all its own way, hasn't it? They make all the margin. People who actually make the Apple phone, they don't have any margin. It's all with Apple, really. So things like that can change. There'll be little all sorts of things like that will happen. But basically, there's a lot of money out there. It's going to pop up somewhere. At the moment, it's, as I said, 1.2 trillion in US money markets alone, and lots of cash everywhere else as well. How does it flow through the economy, and does it flow through? So if the virus starts to wane, if it starts to subside from whatever reason, in terms of fear of economic participants, then it will flow through into the economy. If it doesn't, it will just stay in assets, and some of those will be financial assets. And so that's the decision now. I've probably whittled on too long on that answer now. Did that? Is there anything else on that one, Rob? Do I need to be a bit more specific on things?
No, I think that's good. Thank you very much.
I suppose very quickly, narrow money is near cash. The narrower the money, the nearer cash it is. The broader money, the more you get to other ways of holding cash and cash-like deposits in the system and so on. So if you see people shift from broad to narrow, it means they're either about to spend it, or they could be hoarding it. Whereas when you see both spike, it normally means the banking system is working. So the other caveat is you need a solvent banking system. And so this is what Japan didn't have when their bubble burst. And I would argue Europe didn't have for a while after the Euro crisis. And it took a long time for the Western banking system to repair itself. So that's why you didn't get loan growth after you got money growth before. But this time the central banks are making sure, I think, that the banks lend it out. That's something we're going to have to watch. But we can follow that data. We can watch that month by month.
Okay, thank you, Ian. And is there any worry or concern about China going back into COVID, and how does it come out of COVID, and the knock-on effect that might have on the perception or risk appetite, or people's risk appetite to dip back into emerging market assets?
Yeah, I think that's huge, right? So that is the biggest risk I have that we have to watch out for. But so far, they've gone back to work. There's been no significant increase in cases. There have been isolated pockets. It looks like generally where people have travelled back to that area and brought it with them, actually, so they've re-imported it. And the authorities are obviously very focused on it. And that's the same for other countries in Asia as well, which are generally a bit further ahead on this curve, as it were. But so far, so good is all I can say. Factors are back. Obviously, most of us are not traveling to China at the moment, or traveling anywhere at the moment. But my contacts in China are saying that life is pretty much back to normal. Productivity is a bit lower because of social distancing and so on. You can't get as many people in the restaurant. But the nightclubs are back open. The bars are back open. People are going out and carrying on their lives as normal. They're not wearing the masks as much. They're going out. Everything seems to be normalizing. If you go from a hard stop to normal, that's a very big increase. So I think the idea is we've got to participate in this, and then we'll see how it turns out, because there's a risk of an overshoot here as well with all this money going on, as well as the risk of obviously COVID maybe coming back. And then if it does come back probably next winter, I suspect, I don't know, right? I'm not pretend I'm an epidemiologist, but with using the same Johns Hopkins data as everyone else. If it's generally, these things are usually seasonal. It's a winter thing. If it comes back next winter, we'll see, how bad it is then. But it might not be. It might be less bad every time it comes back, or it could mutate completely. We don't know. It's an efficient disease because it doesn't have a very high mortality rate, basically. That's why it spreads so quickly. A lot of people are not as affected. Some people don't even know they've been affected. So that's why it spreads so well.
Okay, thank you, Ian. In the interest of time, I think I'm going to have to sign off there. Thank you very much for the positive comments on emerging markets and the reasons to invest. As people may know, the fund is available as an offshore fund domiciled in Dublin, in a number of different currencies, and also it's available as a feeder fund here in South Africa. We had a number of questions relating on how to use emerging market assets alongside global equities or South African equities as well. And I think you'll find a number of research articles have been done on the lack of correlation between both global equity and also South African equities. So it really is a good diversifier, and particularly at a point in time where the prospects for the asset class are looking quite attractive. On that note, Ian, I'm just going to say thank you to you, and you can log off now just before I sign off. So thanks for joining us. Thanks for the insights, and keep up the good work on the performance on the portfolio.
Thanks, Rob. Much appreciated. Sorry I didn't get to finish those last couple of pages, but I'll leave that to you to do sometime.
Will do. And so to everyone for joining us today, thank you very much. To everybody who submitted questions and I didn't get round to, my apologies. We did run over time a bit. On the slide, you can see since inception, the fund's outperformed the MSCI emerging markets by 6%, and the Morningstar European peer group by 6% since inception to the end of April this year. You'll see over the longer term, though, over the 25-year history, the consistency of outperformance is quite phenomenal. I mentioned this earlier, in that we can only take the track record back to the beginning of December 2000, due to the fact that the MSCI Emerging Markets Index only started then, which says something given that the strategy has outlived the index. On that note, I'd like to say goodbye. Please join us for another Insights webinar on Friday when Trevor Garvin, our head of multi-manager, will be talking to JP Landman, political and trend analyst, someone that always provides us with incredible insights into what's going on in the environment in SA. And on that note, thank you very much for joining us, and please have a good day.